Okay, guys. So we're going to start today with chapter 6. This is kind of a fun chapter. Cost, volume, profit analysis. I mean, this, guys, we can use in all walks of business. So excuse me. So with cost, volume, profit analysis, we're really going to spend time understanding the various categories of costs related to being variable costs, fixed cost, and mixed costs. So with companies that have a lot of fixed costs, they can be at risk when the economy is bad because they've got a lot of heavy costs that aren't going to change no matter what their volume is. When companies have higher variable cost and lower fixed costs, they're more capable of getting by during hard times because when the sales go down, their costs can go down easier. So it's always a double-edged sword, I should say. When there's a lot higher fixed costs, when times are good, you do really, really well. When times are bad, it can be really, really hard to make it. And the opposite is true when companies have heavy variable costs and low fixed costs. When times are bad, they can make it. But when times are good, they're not going to do as well as those companies that are structured different. That's what we're going to talk about today. So we're going to talk about cost behavior. It's cost change as related activities change. The behavior of a cost depends on the following: identifying the activities that cause the costs to change, which we call those cost drivers or bases. And we kind of specify the range of activity over which the changes in cost are of interest, which we call the relevant range. Costs are usually classified as fixed, variable, or mixed costs, where there's a little combination of both. Variable costs vary in proportion to changes in the activity base. When the activity base is units produced, the direct materials and direct labor are normally classified as variable costs, because if the activity base is units produced, if you produce 100 units, those direct labor and direct material costs are going to be based on 100 units. If the activity base then shows 1,000 units, can't you see how the direct materials and direct labor is going to be a heck of a lot more than if they're only producing 100 units? Does that make sense? So when the activity base is considered the units produced, the direct materials and direct labor are classified as variable costs. Jason Sound produces stereo systems. And for model JS12, the relevant range is between 5,000 and 30,000 units. That's a big relevant range. Okay, so the relevant range is pretty significant, between 5,000 of these units up to 30,000 of these units. So you can see here, the direct materials per unit, if they produce 5,000 units or if they produce 30,000 units, it's going to be $10 per unit. The total direct material cost, when it's 5,000 units, it's $50,000. When it's 30,000 units, it's $300,000. The cost is going to be in relation to the units produced. So they're going to be variable. They're fixed per each unit, but they're variable based on how many units are being produced. The cost per unit is the same regardless of changes in the activity base, but the total cost goes up as the units produced goes up. That makes sense, doesn't it? Here, this is where you see a variable cost. The horizontal line is the units produced. The vertical line are the costs. You see that as the number of units produced goes up, the cost goes up. That's variable. As in terms of per unit, the variable cost stays at $10, but as the number of units produced goes up, the per unit doesn't go up, but the overall total cost go up. So here you see variable costs and their activity bases. You could take a look at what our instructors' salaries per university, and we'd base that on the number of classes. Or with airlines, when we look at the cost being fuel, we'd look at the number of miles flown. Because the more the number of miles, the more the fuel cost is going to be, right? In manufacturing, when we look at direct materials, we're going to look at how many units are produced. A hospital, if we're just looking at the nurses' wages, we're going to want to know how many patients there are. Hotel, for housekeeping, number of guests, or I should say number of rooms. For a bank, the teller wages, you'd look at the number of banking transactions. So what this is showing, with the cost, there's always a driver, something that drives, pushes the cost up or down. So those are here examples of the variable costs and their related activity base. So as we see here, fixed costs have the following characteristics. The cost per unit will decrease as the activity level increases, and it increases as the activity level decreases. For Jane Sovisi, do we have her in here? Jane Sovisi has a salary of $75,000. And the cost per unit went down from $1.50 for 50,000 bottles down to 25 cents per bottle for 300,000 bottles produced. So her salary is fixed, no matter if they produce 50,000 bottles or 300,000 bottles. Per unit, it decreases. As they sell less or produce less units per bottle, it increases. It's a fixed amount. Total costs remain the same regardless of changes in the activity base. Jane's salary of $75,000 remained the same no matter how many bottles were being produced. Do you see how that's a fixed cost? Does that make sense? Rent would be a fixed cost within a relevant range. If we're teaching classes, this school, say they teach 100 classes in seated a week, we have the space for those 100 classes in the relevant range. If Anoka Ramsey went and then started having seated classes of 500, well, that's not in the relevant range. We can't handle 500 classes in here. Does that make sense what the relevant range is? So the rent on this building or what the payment is going to stay the same if we teach 10 classes seated or 100 classes seated. Does that make sense? This slide here shows how Jane's salary, which is a fixed cost, behaves in total and on a per unit basis as production changes. Some examples of fixed costs and their related activity bases are shown here, like the building. If we depreciate it, the straight line building on a university, and if we take the number of students to be the activity base, then as we have more students, that per unit cost per student goes down. A passenger airline, if we show the airline and the airplane and we're just depreciating the actual airplane, the more miles that airplane flies, their costs go down per mile being flown. Okay. A plant manager's salary is fixed. The more units get produced, that plant manager's salary can be spread over a lot more units. So the cost goes down. Insurance on a hospital, if we base it on the number of patients, you see how that's a fixed cost? So if we have 100 patients versus 1,000 patients, that insurance cost with only 100 patients is going to be higher per patient. But if we've got more of the activity base, that cost is spread out over more patients. Hotel, the property taxes are fixed. It doesn't matter how many guests we have, the property taxes are fixed. A bank, the branch manager's salary is going to stay the same no matter how many transactions are involved. So mixed costs are a little bit of both. They have characteristics that are both a little bit of variable and a bit of fixed. Mixed costs can sometimes be called semi-fixed or semi-variable. Simpson manufactures sales using rented machinery with the rental charges as shown. So if they pay $15,000 per year to rent this machine, but then they have to pay $1 for each hour over 10,000 hours. Do you see how it's a combination of fixed and mixed? It's fixed up to 10,000 hours. And then once they hit that 10,000 mark, they have to pay $1 an hour. The rental charges for various hours used within the relevant range of 8,000 hours to 40,000 hours are shown here. Remember, at 8,000 hours, they can go up to 10. So at 8,000 hours, it's fixed at 15,000. But then once they start going after that over the 10,000, they pay an extra $1 an hour. So if they are then doing 20,000 hours with the machine, they're going to pay $25,000, which is the fixed 15,000 plus $1 anything over the 10,000 hours. So it's a little bit of both. Here we see the exhibit here of what a mixed cost looks like on the graph. You see for a period of time, it's fixed. And then after a certain point, it becomes variable. So We are going to look at a couple different ways that we can estimate these costs. The high-low method is a cost estimation method that separates mixed cost into the fixed component and the variable component. The high-low uses the highest and the lowest activity levels and their related costs to estimate the variable cost per unit and the fixed cost. Here we've got a maintenance department, and the maintenance department incurred the following costs. In June, they produced 1,000 units at $45,550. July, it was 1,500 units at $52,000. August, 2,100 units at $61,500. September, 1,800 units at $57,500. And then October was at the lowest point, 750 units at $41,250. So our activity base is going to be units produced. And the relevant range is between 750 units up to 2,100 units, as we see in here. Okay. So with this company, the difference between the units produced and the total cost at the high level and the low level are shown here. So the highest level, 2,100 units, it cost them $61,500. At the lowest level, it was 750 units at $41,250. So that difference between the 750 and the 2,100s, 1,350 units, with the cost difference from the high to low to being 20,250. So that 20,250 is the change in the total variable cost by really dividing the difference of that 20,250 by the difference in production. So if we take that 20,250, the difference between the highest and the lowest, divide that by the difference in production, that's then how we can come up with the variable cost per unit of $15. So the way we figure out the fixed cost, it's going to be all the total cost minus that variable cost per unit times the number of units that get produced. So that's a way we can split the fixed portion from the variable portion. The fixed cost is the same at the highest and the lowest level of productions. So we use that variable cost per unit and then the fixed cost so we can compute which is which. So if we've got the cost of 2,000 units of production, we say it's 60,000 because we take our $15 per unit at our 2,000 units plus our 30,000 fixed. Okay? So we take the 30 plus the 30 to give us what our total costs are. That's the high-low method. Now, mixed costs contain the fixed cost component that's incurred even if nothing gets produced. So that's why it's fixed cost. You're still going to have that cost even if you sit and do nothing. The fixed and variable cost components of mixed costs get separated using that high-low method. This exhibit here, this slide, shows some examples of the variable, the fixed, and the mixed costs for the activity base of units produced. So when we've got variable costs, we know that can be direct material, direct labor. Electricity expense is going to be variable based on what's being produced, and supplies are variable. Fixed costs, such as property taxes or insurance or depreciation or supervisors' salaries, are always going to be fixed. And then we've got some mixed costs that have a little bit of component of each. So guys, what do you think of this one? Which of the following costs remain the same regardless of activity level within the relevant range? Total variable cost and unit variable cost, total fixed cost and unit variable cost, total variable cost and unit fixed cost, or total fixed cost and unit fixed cost? What do you think? Anyone? Anyone want to guess? Remember that unit variable cost, remember, as we produce more units, the materials increase. But in that first example, per unit, we paid materials of $10 a unit. Okay, no matter what. As we made 10,000 units, it was $10,000. As we did 100,000 units, it became $100,000, or maybe a million. I'm getting my zeros mixed up. But the unit cost stayed the same, right? Let's look at this exercise. Here's a list of various costs incurred in producing replacement automobile parts. With respect to the production and sale of these auto parts, classify each cost as either variable, fixed, or mixed. Now, this is a company that is producing replacement automobile parts. So the oil used in manufacturing equipment, wouldn't you say that's variable because the more you're using the equipment, the more oil you need? What about plastic? Wouldn't that be variable too? The more you produce, the more you need. Property taxes, it doesn't matter. That building has a set amount of property taxes based on the value of the building. It's nothing about what you're doing inside of that building. Does that make sense? Salary of plant manager, that's fixed. The plant manager's on a salary basis, so it doesn't really matter what's getting produced. He's going to get paid no matter how much they produce. Cost of labor for hourly workers, the more they work, the more the cost is, right? The more they produce, the more they need to work, the more the cost. Do you see how that's variable? Packaging is variable. And do you understand why? The more you're producing, the more you need a package to ship. What about factory cleaning costs of a flat $6,000 a month? Fixed. Metal, variable. The rent on the warehouse. Do you see how it's giving you a little bit of both? They pay $10,000 per month plus $25 per square footage of storage used. It's mixed. Property insurance premiums on this one is mixed because it's a flat rate plus then it's 1 cent of each dollar over 1.2 million. What about depreciation? If that machine produces 10,000 units or 20, that depreciation that's taken on that machine is going to stay the same. Hourly wages of machine operators, variable. Electricity cost, the reason that's variable is the more usage of the machines, the more the electricity goes, right? Make sense? Computer chip, because they're used in the parts. The pension cost, the more they're producing, the more hours, the more labor, how it's variable. Does this make sense, guys? Do you see here? We have these various graphs. For each of the following costs, identify the cost graph that best illustrates its cost behavior as the number of units produced increases. So with the direct material cost, as you produce more, the cost is going to go up. Do you see that? 3, the more units produced, the more the cost increases. The per unit cost, the electricity cost of 1,000 per month plus 10 cents extra per kilowatt hour. The reason we know that's a mixed cost, it starts at a certain level and then goes up from there. Depreciation equipment is going to be, let me just see here. Straight line depreciation on factory equipment. Okay, so this one, if we're using the number of units increase, the depreciation per unit cost of straight line depreciation on factory equipment. The cost is high if nothing's produced, but then as more is produced, do you see how the cost incrementally goes down per the units produced? If what we're saying is, how much is that depreciation per unit affecting the cost as the units increase? So when there's not much being produced, the cost is high. As we increase our units of production, the cost on that depreciation per unit gets really low. Salary of quality control supervisor at $20,000 a month, isn't that just fixed? Per unit direct labor costs, that would be also graph 2. Direct labor costs per unit are going to stay the same. They increase as we produce more, but they're going to stay the same per unit. Okay. This is just kind of what we talked about in some previous slides of if we try to come up with a cost, we want to look and come up with an activity driver or a base that drives those costs. So it makes sense. Instructor salaries are based on either the number of classes or student credit hours. Office supplies would be based on number of students. This is in a university. Financial aid office salaries, how many financial aid applications are out there. So you want to find what drives the cost. Okay. Here from the following list, select the base that would be most appropriate for these costs. Would it be preparation costs of each car received? Would it be sales commissions? Or would it be administrative costs for ordering the cars? So basically, you see that each of these costs are driven by a sense of a driver. I'm going to move on because I do this. I put too many in here, but you guys can sure look at them later. So relevant range, let me see what that was. Fixed and various. I don't know what I was doing there. So let's talk about what we're looking at with this cost and volume as it relates to profits connection. The CVP analysis is a tool managers use to examine the relationships among the selling price, the sales and production volume, costs, expenses, and profits, and is useful for managerial decision making. The way this analysis is used is to look and see what changes happen in selling prices on profits. If we move and change the selling price, how does that affect the change in our profits? Or how, when we change the costs, how does that change our profits? If we change the volume, how does that change our profits? Setting prices, selecting the mix of products to sell. What's going to give us the higher profit margin? Is it selling strollers or is it selling car seats? Or does it matter? And then various marketing strategies that can be used in sales. The contribution margin is what's above and beyond the selling of a unit minus the variable cost. So sales minus variable costs give us what we can apply towards fixed costs. Contribution margins, the amount of revenue that's available for covering our fixed costs, but we want to do more than cover fixed costs. We want to earn a profit. Let's look at Lambert Inc. It tells us they sold 50,000 units, and they sold those units at $20 a unit. The variable cost per unit is $12. Okay? Per unit. That's what it cost for them in variable cost to create those units. And it gives us that the fixed cost for Lambert is $300,000. So we can look at what we call a contribution margin income statement, where we take our sales, we subtract all the variable costs. So the sales of $1 million minus our variable cost of $600,000 give us a contribution margin of $400,000. From there, if we subtract our fixed costs, then we're ending up with a profit here of $100,000. So guys, it's taking the same numbers, but we're formatting them a bit differently because our focus is on seeing how much after our variable costs are covered do we have to take care of our fixed cost. And then after that, we show our profit. So this shows you the contribution margin format. Companies with high contribution ratios and excess capacity often use special sales campaigns or other promotions to help increase their sales. So you see the contribution margin ratio, which we'll call the profit volume ratio, shows the percentage of each sales dollar that's available to cover fixed expenses and then to provide some extra profit. So if we take the contribution margin and divide that by our sales, that shows us that for every sale, 40% can go to cover our fixed costs, plus help us earn a profit. Does that make sense? Lambert earned $100,000 in that previous slide of profit. They earned $100,000 when they sold $1 million. But what happens? You see, that's what this contribution margin's about. What ifs? But what happens if Lambert increased its sales by 80,000, meaning they sold 4,000 more units at $20? So instead of selling 50,000 units, what if they sell 54,000 units? Well, their operating income would go up by 32,000 because you would take that extra 80,000, multiply it times 40%, which is the contribution ratio, and they would then have an additional 32,000 in profit from that. Okay. Okay. The preceding analysis that we're talking about, you can spell it out long term. You take the sales minus the variable costs, give you the contribution margin, less your fixed cost, they were 300,000, gives you the operating income. The unit contribution margin is determined by the sales price per unit minus the variable cost per unit. It's that straightforward. Lambert's selling price is $20. Its variable cost is 12. What that means is the selling price minus the variable cost give us the contribution margin per unit, $8 per unit. When a change in sales volume is measured in units, the contribution margin can be used to compute the change in operating income. So if you increase sales by so many units and you just add that contribution margin per unit, you see how your sales increase. Okay? If Lambert earns operating income of 100,000, that was on a slide about 5 ago, when 50,000 units are sold, what happens if they sell an additional 15,000 units? Well, that 15, we started with 100,000. If they sell an additional 15,000 units at $8 a unit for those extra 15, do you see how then they add an extra $120,000 to their already operating income of 100? Okay, think of a local supermarket or a grocery store. Think of the location within the store of milk and bread. Given their location and cost, assumed unit of contribution margin, do you think these items have a high or low contribution margin ratio versus specialty items? What do you think? Where do you normally find milk and bread in a store? Isn't it in the way back? Isn't it? Why? Because they're probably not providing a big profit for the store, right? So they're not going to put them in the prime location, the prime square footage of the store. Don't you think more of the specialty items are given the better square footage of a store or the better location of a store? Does that make sense? I'm thinking of 494. Do you guys ever drive down 494 and you see these big auto buildings with pure glass, and you see this awesome like Ferrari up at the top? Why are they given so much attention and notice? Lots of money, aren't they? Selling one or two of those is going to bring in a lot of contribution margin to those businesses. Do you understand what I'm trying to say? Any of you guys have input on this? Does it make sense? You probably don't grocery shop very often, do you? You do? Thank God for what do you call those services now? Walmart delivers my groceries for free. Well, you pay a tip, but it's so worth it. What do you think of the placement of staples within the store, as well as other items within a typical layout of a grocery store? Well, guys, the ones that are going to make the most money are going to be the ones that are easily accessible. That's just common sense, isn't it? Okay. Now, we can just do a simple mathematical approach to this cost volume profit. The mathematical approach uses equations to determine the following: the sales necessary to break even, or the sales necessary to make a specific or desired profit. The break-even point is only where revenues equal expenses and nothing above. Okay, that's breaking even. So the break-even point in sales units is computed by units equal the fixed cost divided by our unit contribution margin, because you have to make that many just to cover your fixed costs. So revenues minus costs equals 0. That's break even. So let's say break even. We've got Baker here. Baker has 90,000 of fixed costs, but their unit contribution margin, which means their sales minus their variable costs per unit, is $10. The break-even point for Baker is 9,000 units because they need $90,000 to cover their 90,000 in fixed costs, right? 9,000 units at $10 a unit for a contribution margin. Baker's income statement is going to show the 9,000 units at $25 a unit, showing the sales of 225,000. Their variable costs are the 9,000 units at $15 a unit. The difference between the sales minus the variable cost is called the contribution margin of 90,000. That's just enough to cover their fixed costs. So the sales of $225,000 will generate a contribution margin of 90,000, which covers the cost. Another way we can look at that is the contribution margin ratio is 40%, meaning with each unit sold, they bring in 40% to cover their fixed costs. So you see, if 90,000 are the fixed cost, and you divide that by the contribution margin ratio, you know how much you need to sell to break even. So that's just given the base to break even. But the break even point gets affected by changes in fixed cost, unit variable cost, and the unit selling price. Fixed costs don't change in total when changes in the level of activity happen, but they can change for advertising or changes in property taxes or supervisor salaries. So let's just say here, Bishop's evaluating a proposal to budget for an extra $100,000 in advertising. So they're adding $100,000 to their fixed costs. So right now, their fixed costs, we're at $600,000. But because they're looking at spending another $100,000 in advertising, they're budgeting out, what do we need to sell in order to handle $700,000 in fixed costs. So basically, the break-even point before that extra 100,000 was showing at 30,000 units. They needed to sell 30,000 units to break even. But because now they want to increase their fixed costs by 100,000, they need to then figure out how many units need to be sold to break even with an additional 100,000 in fixed costs. So now you take the 700,000 in fixed costs divided by that unit contribution margin of 20, and we see now we need to sell 35,000 units just to break even on fixed costs of $100,000. So it's an extra 5,000 units they need to sell in order to come up with that extra 100,000 in advertising. Changes in fixed costs affect the break-even point. It's increasing the fixed costs. Increasing fixed costs increase the break-even point. Decreasing fixed costs decrease the break-even point. That's pretty logical. There's less money you need in order to cover those fixed costs. Unit costs, variable costs, do not change with changes in the level of activity. But variable costs may be affected by changes in the cost per unit of direct materials, the wage rate, or the sales commission paid to the salespeople. Assume part companies evaluating a proposal to pay an additional 2% commission on sales to its salespeople as a way to help increase sales. So in this case, the unit variable cost is going up because they're considering what happens if we do increase the commissions, which increases the unit cost per sold. That's sold. So they're selling the units for 250. We're proposing to add an extra $5 of variable costs onto the cost of the units, which lowers the contribution margin per unit. So do you see our contribution margin was at $105? By increasing one of those costs, it's going to lower it to just $100. So our fixed costs are going to stay the same. But what happened in this scenario is our unit variable cost is increasing. As a result, that lowers our unit contribution ratio, and we're going to need to sell more units in order to cover that variable cost. So in this case, that extra 2% commission is 8,000 units. So in order to cover our 840,000 fixed costs, and we were at $105 per unit contribution margin, that was 8,000 units. By the time, if we show our 840,000 with our new contribution margin of 100, we would need to sell 400 more units to cover that extra variable cost. Does that make sense how we're looking at this? An additional 400,000 units are required to break even. Changes in unit variable cost affect the break-even point because the increase in the unit variable cost increases the break-even point, where decreases in the unit variable cost would decrease the break-even point, meaning it costs more. You can also look at this by altering the sales price, the selling price. Changes in the unit selling price affect the unit contribution margin and also the break-even. So if Graham wants to increase the selling price from what was currently $50 now to $60, that's going to change the contribution margin per unit. It's going to increase it by $10. So it was at $20. Now the unit contribution margin is at $30. Graham's break-even point had been at 30,000 units to break even. But do you see if Graham changes the selling price, they have to sell only 20,000 units to break even? Make sense? So many different factors, changing the selling price, changing the variable cost per unit, or changing fixed costs, all alter not only the contribution margin, but then the break even. So the break even point in sales changes in the same direction as changes in the variable costs per unit and fixed costs. But the break-even point in sales changes in the opposite direction as changes in the unit selling price. So you see here, when fixed costs increase, the effect on the break-even sales increases. When fixed costs decrease, the break-even sales will also decrease. When the unit price per selling increases, the break-even on sales is going to decrease. So this is, again, it all logically makes sense. It's just a simplified way for management to have tools in place to see where changes in one, how this affects the whole. By modifying the break-even equation, the sales required to earn a target or desired amount of profit can be figured out by fixed cost plus target profit divided by unit contribution margin will give you what you need to sell. If Waltham has fixed cost of 200,000, they want to make 100,000 in profit. And we know the contribution margin is $30 per unit. Do you see? It's a simple equation. You take the break even of 200,000 plus your $100,000 profit. So you take $300,000, divide that by $30 per unit, and you know you need to sell 10,000 units to make that happen. So if the sales of 750,000 is needed to earn that $100,000 profit, you can also figure that by the contribution margin ratio. You take the fixed cost plus what you want to earn as the profit, and you divide that by the contribution margin ratio to know how much needs to be sold. Okay, so you can figure this out by unit sales and the amount of sales. Let's look at this one, guys. I want you guys to attempt this. Kathy's confectionery has fixed cost of $78,000 and would like to earn a target profit of $90,000. Its product sells for $15 and has a unit variable cost of $12. How many units of the product must be sold to attain the target profit. I'm going to give you a minute here. What do you guys think? A, because we can take the 78,000 of fixed costs plus what we want our profit to be of 90, 168,000 divided by $3 contribution margin a unit, and come up with how many units of 56,000. Okay. Now there's different approaches, graphically speaking, that we can look at the break-even chart. This cost volume profit chart, which is basically a break-even chart, graphically shows where the sales and the costs intersect. The cost volume profit chart that we're going to see is based on fixed cost of 100,000, selling price of $50, variable cost of $30, and the unit contribution of 20. So basically, we look at, here we look at the volume in the horizontal. We show our costs in the vertical. To break even, we need to have 5,000 units, and our costs, the sales and the cost are at $250,000 to just break even. Anything below that is going to be a loss, and anything above that's going to be a profit. Does that make sense? So this is a great slide to show the volume that needs to be sold and how the costs, it just is a great graphic at showing where you need to be and what happens on either end. This needs 200,000 of sales, which basically is the break even of all the costs. Operating profits will be earned once that break even point increases. Operating losses are going to happen when sales levels are to the left of the break even, and profits happen when sales are to the right of the break even. Here, you'll be able to see as the selling price or the total fixed cost or the total unit variable cost. As you change those, it all affects the break even. Okay. Here, this is altered because now we changed this. The fixed costs are now going to be 80,000, and So what we did in this scenario is we reduced our fixed costs by 20,000. By reducing our fixed costs by 20,000, do you see now our break-even point happens with sales of 200,000? Okay. The profit volume chart plots the difference between total sales and total costs. The profit volume chart helps managers figure out what they need to sell to desire a certain level of profitability. Okay. So again, here, this slide shows the break-even point for 5,000 units of sales, which is equal to the sale price of 250,000, 5,000 units at $50 a unit. Operating profit is going to be earned as we move to the to the right of the break even. At sales of 8,000 units, so if we move up here, instead of 5,000 units, if we sell 8,000 units, look at what the profit is going to be here. The profit is at 60,000 bucks. So this is just a great way to see where you're going to stand based on the units sold. Okay. Spreadsheets are a great way of being able to chart this information and display it. Many companies sell more than one product at different selling prices. Break-even analysis can be performed using a sales mix. The sales mix is really distributing what products are being sold by a company. Here, Cascade sells two products, product A and B. Product A has a contribution margin of $20. Product B has a contribution margin of $45. You see that the product A has a lot more units that are being sold. They are selling 8,000 units to the 2,000 units that are being sold by product B. So do you see, basically we can still use this concept. We just have to come up with the sales mix. If 80% of product A are sold and 20% of product B are sold, we have to come up with the contribution margin based on that sales mix. So if we look at the sales mix for Cascade, a total of 10,000 units were sold during the year. Therefore, the sales mix is 80% for product A and 20% for product B. We're selling a lot more product A, but it's got a lower contribution margin than product B. Here, you can figure out how you come up with a revised contribution margin. So product M is what we're going to call the mix between product A and B. We come up with the selling price of that mix because 80% are selling product A, 20% are only being sold of product B. So we come up with 80% of $90 plus 20% of $140 averages out to $100. And then we come up with our variable cost. If product A has a $70 variable cost and product B has a $95 variable cost, we take the ratio of what's being sold, 80% of 70, $56, plus 20% of 95 or $19 to come up with
Marcel Koning Business.
Sorry. we come up with a unit variable cost of the mix, and then as a result can come up with the contribution margin. Okay. And ultimately, then we just need to, we process through it the same way. It's just we create that mix to come up with the weighted contribution margin. Okay. Operating leverage. This is the relationship between the company's contribution margin and operating income. The difference between the contribution margin and operating income is all about fixed costs. So companies with high fixed cost have a much higher operating leverage. Here we've got two companies. One's Jones, one is Wilson. Do you see that Jones has fixed cost of $80,000 versus Wilson has fixed cost of $50,000? So in this manner, Jones has higher fixed cost, higher risk than Wilson would. They have the same sales. They have the same variable costs and ultimately the same contribution margin. But since Jones has higher fixed costs, they're going to have a higher operating leverage. So Jones has an operating leverage of 5, which is riskier than Wilson having an operating leverage of 2. So a change in sales has a big impact on the change of operating income. If sales increased by 10% or 40,000 for both Jones and Wilson, then the percent change in sales times that operating leverage will show the change in operating income. Jones' operating income is going to increase by 50%. Wilson's operating income is only going to increase by 20%. Okay? Even with a small increase in sales, it's going to generate a bigger increase in operating income. The impact of a change in sales on operating income for companies with high and low operating leverages is shown here. When your operating leverage is high, your impact in operating income can be high. When the operating leverage is low, the change in sales is low. That margin of safety provides you with when there might be a decrease in sales, how does that affect the overall figures? So if we show sales at 250,000 and the sales at the break even are 200, and we have a unit selling price of 25, we can understand what our margin of safety is, meaning the margin of safety in terms of dollars is 50,000, meaning we are at 250, but we need to be at 200 just to break even. So we've got a $50,000 margin of safety. And in units, we can compute that by taking our 50,000, dividing it by the sale price to figure out how many units we are with the margin of safety. Okay. Whitman Industries had sales of 800,000 at the end of the year. Its break-even point for sales was 680,000. What is the margin of safety expressed as a percentage of sales? You see, we take our sales minus our sales at break even, divide that by our total sales. Sorry, guys. To know what our margin of safety is in terms of percent of sales. Service companies. We can use this for manufacturing companies, but we can also use this for service companies. So we can figure out relationships measured with education, break-even number of students per course. So when we teach, they're not going to hold a class when only 2 or 3 students are enrolled. Why not? It's just not sound. It's not an economically smart decision just to cover all the overhead that goes out to hold that class. Doesn't that make sense? So have you ever had a class that gets canceled? No? Usually it's going to get canceled because it's just not filling up. And of course, they can schedule it during another semester. Air transportation. I love nothing more than to be on a flight that's empty, but they're not probably making money on those flights when there's only 30 passengers on board. Healthcare, hotels. I mean, even though a hotel may have 100 rooms, to break even, they might only need to be selling half those rooms a night. But usually most businesses know what they need to produce in order to just cover their costs. Okay. Let's look at students for a non-credit course in a pottery class with a $500 tuition. So it costs $500, but the pottery supplies and the enrollment cost are $320. So even though they're bringing in $500, the costs are $320 per student. So they're really only profiting $180 per student. But then you've got the rent of the classroom, the instructor salaries. So they need to take that $4,500 in fixed costs divided by the $180 of contribution margin per student, and you see that class needs to have at least 25 students just to break even. Make sense? Cost, well, we're not going to worry about that. Any questions on this? This is a great managerial tool used to just give some generic views on what needs to be sold, or if the sales price changes, how that changes the break even. Anybody have questions on this? You guys good? Yes?